Global economic leaders meet in Istanbul to bolster recovery and prevent future crises. Amid cries for reform by the new players on the world economic stage, can they deliver on their main target, or will it turn into a power struggle between the old and the new? This is Inside Story. Hello there and welcome to the show. I'm Nick Clark, assessing the damage of the global economic meltdown. World leaders and financial chiefs are in Istanbul for the annual meeting of the International Monetary Fund and the World Bank. The two-day event kicked off on Tuesday, topping the agenda, surprise, surprise, the economic crisis, but also internal reforms. They'll also discuss a new global economic outlook, eradication of poverty and effectiveness of aid. So what is the shape of the new world financial order? Here's Nicole Johnston.
This is the brave new world of global finance. The G7 is dead, replaced by the G20. The developed world shifting into the shadow of developing countries, led by two economic powerhouses, India and China.
We can see potential shifts in power, in institutions, and international cooperation. In part, the shifts will depend on how the parties adapt to the new circumstances.
The World Bank and the International Monetary Fund are meeting in Istanbul. Their legitimacy at stake. Both organisations have had to change.
This is a process that will take time. It will not happen overnight. We are reforming an organisation that is complex, sophisticated, and reaching every corner of the world economy.
The IMF's ambition is to become a global central bank with a $1 trillion balance to lend to developing countries. But Malaysia's Minister of International Trade says so far the IMF's response to the crisis has been poor and its influence is waning.
We thought the IMF and World Bank would have come earlier to prescribe good policies. Obviously, they did not do that in good time. As a result, the situation became bad.
The World Bank is also bracing for a shake-up. It's long been accused of tying dubious economic reform to its loans, reforms which frequently stifled local industries and allowed in cheap imports. It now has to reflect the shifting balance of power from the West to the East by giving the developing world greater voting power.
For as long as developing country views are not being heard by international bodies like IMF and World Bank, we're going to have policies which are lopsided.
Out of date and out of ideas, the Group of Seven is over. The global economic order has been turned upside down, and developing countries are now trying to steer the world out of this financial crisis. It may turn out to be a slow journey. Nicole Johnston for Inside Story.
So, reforming the IMF and the World Bank, one of the key issues being discussed at the summit. Member states want increased transparency and more efficiency in how the bank uses its resources. Emerging economies like Brazil, China and India want a redistribution of power. They would like voting powers to be consistent with a country's contribution to the global economy. This appeal in line with the decision made at the G20 meeting in Pittsburgh last month. Leaders agreed to redistribute 3% of the voting power in the World Bank and 5% in the IMF in favour of the emerging economies. Well, glad to say to discuss all this are our guests in Istanbul, Peter Attard-Montalto, an emerging markets economist at Nomura International, and in London, Jan Randolph, Director of Sovereign Risk at IHS Global Insight. First up, gents, let's get a general view from the host city, from Istanbul. Peter Attard-Montalto, what mood are you gauging there right now?
I think there's definitely a more positive mood than there was at this meeting last year. Obviously, that was right in the centre of the crisis at that time. Also, much more positive than at Davos at the start of the year. And the mood of these conferences is incredibly important for policymakers, what they take back to their countries, what they say to the people back home. There is a lot of caution, though, around W shapes, for instance, the shape of the recovery. Still some uncertainty as well around what some of the new policies, such as coordinated fiscal and monetary policy, actually means. Still some disagreements over that, as well as over the reform of voting rights and issues like that. But overall, definitely a much more positive mood.
All right, one of the main items on the agenda, as we've already said, is this issue of reform. The G7 is dead, long live G20. Do you think this new world order is going to make its presence felt in a hurry, Jan Randolph?
Well, I certainly think we're moving towards the end of an era. We won't probably realise that until a few years from now. G20 certainly has established itself. Back in London in April, when we faced maximum danger with an abyss in terms of financial meltdown, global economy in recession, a free fall, G20 did actually get their act together. They did argue about which policies and how much, but they all basically moved in the same direction, and that basically increased the chances of success. And we're now past that moment of maximum danger. But the G20 forum will find itself and assert itself as the premier body for deciding the big questions that affect all of us, global financial architecture. At centre, of course, is the IMF and World Bank. And I think, if anything, the global crisis and the G20 have enhanced its role. Its firepower is 3 times as big as it was. A lot of talk about what functions, additional functions it should take.
But in a sense, its legitimacy is at stake, is very much at stake right now, isn't it?
It is true. It is true that, you know, if we look at the nitty-gritty, the voting rights, if you like, they still very much reflect the hallmark stamps of the power structures immediately after the Second World War. And that means a very small role, very, very small role for emerging markets, including the new big emerging market economic powers, China and India, completely disproportionate to their economic stamp, if you like, or the economic influence they now wield. And they are two economies still growing, of course. Emerging economies have shown that they can grow without the West. The West is still basically flat on its back. And emerging nations are growing. They won't get ready for a real recovery until the West recovers, of course. But they have demonstrated they can continue to grow. The politics will always lag the economics. But the institutions of IMF and World Bank have been bolstered by G20. I think the emerging market nations, China, India and Brazil, Russia, they've all bought the new IMF bonds issued since July, so they're new creditors. They are ready to take a greater influence in these bodies, but the voting shares will slowly move in their direction.
Okay, let's bring that in, bring that across to Peter. This issue of voting shares shifting, if you like, towards China, India and Brazil. Do you think that's going to be a straightforward process?
Well, I think there's going to obviously be a lot of pushback from the developed world who, for instance, the UK wants to keep its permanent seat on the IMF board. But actually, I think the whole voting thing is somewhat secondary in many ways. I think we have to remember that the IMF has been incredibly important in for instance, providing a cushion under Eastern Europe in particular, both in terms of actual economies themselves and for investors. And the world would be a very, very different place if we hadn't had IMF packages in Romania, in Hungary, in Iceland, and indeed many other forms of funding that the IMF have provided throughout Africa has helped to smooth this crisis for that region as well. So I think we have to bear that in mind. But I think the voting is secondary for a lot of emerging markets. I've met many policymakers across the last 3 or 4 days, and they are basically getting on with the job of rebalancing their economies. They're thinking very actively about what they can do to come out of this crisis in a credit-constrained world where FDI, for instance, is going to be perhaps half what it was at the peak in 2007. So basically they're getting on with their job of managing their economies and providing a better outlook, talking to investors here in Istanbul about securing funding for that where they can. So I think that's been one of the areas that surprised me most in this conference, is that proactive nature of emerging market policymakers, despite the politics and reform issues of the IMF. Though clearly, I mean, that's always of a lot of interest in terms of pride, etc., in terms of being seen to shape policy on the global stage. But there is more going on apart from just policy issues like that.
Okay, Jan, do you think the voting share issue is secondary? Moves are being blocked by the UK, amongst others.
Well, as I said, the nitty-gritty politics will always lag, but they are moving in the right direction. It may not be as fast as the economic shifts that are very, very much evident in terms of growth, size and importance in terms of the global economy. But I think the key point for me is that China, India, Russia and Brazil, they haven't rejected the IMF, far from it. They've actually boosted its reserves. They've lent to it by buying up new IMF bonds. They want an enhanced role for the IMF, and IMF management and IMF staff are ready to embrace the G20. So, you know, they feed each other basically. You know, they're looking at each other and say, yeah, we are the new future. The lingering issues, what happens to G7 and what happens to, what do the original major shareholders, G7, think about all this? And I think basically they've accepted that there is going to be this slow shift. What kind of role exactly, enhanced roles, the likes of China and India and Brazil want from the IMF is an interesting question. Do they want the IMF to have a more central, global central bank functions? What kind of policies do they actually want from the IMF? The IMF is now listening to G20. It's their new mandate to listen to G20. But what does G20 really want from the IMF and World Bank?
If we do see this this slow shift, this rebalancing, if you like, are we going to see a more powerful organisation? Because there's more room for argument apart from anything else, isn't there, Jan?
Yeah, I think so. I think instinctively, the Chinese particularly, but also to a certain extent the others, are more statist. They're more comfortable with intervention. After all, Chinese recovery, if we can call it that, was very much old-fashioned state policy directing its state-owned banks to lend more. It was very effective in resuscitating growth in that country, and it benefited obviously other countries as well. I think the institutions of IMF and World Bank have shown themselves to be extremely useful, particularly in crisis. A lot of criticism about the way they've undertaken conditionality in terms of their funding, but nevertheless they have been pretty fast in terms of and swift in helping those countries caught out worst, if you like, by the credit crunch, where banks have had to they've been reluctant to refinance. That puts huge downward pressure on foreign exchange reserves for countries like Latvia, Hungary, Ukraine, Pakistan, and so on. And the IMF has come in very quickly as an alternative refinancing source, but it can't just hand over the money. There's got to be some kind of conditions. There's got to be some easing of imbalances. There's got to be some winding down of excessive debt. Some of these economies overheated, you know, and there is a necessary unwinding and healing process involved, including policy changes which are required. But you know, the IMF has been swift, and behind that, G20 did agree quite concretely in April to triple its resources and also look at other ways in which it can facilitate finance where it has been withdrawn because of the commercial bank's own problems, particularly in the area of trade finance, which is absolutely critical for all the emerging markets, but particularly the developing, the weaker ones. Trade finance withdrawn because of Western bank commercial problems. You know, there is a legitimate reason here for the IMF, the World Bank, and other sister bodies to come in and provide an alternative refinancing facility to ensure that these economies can continue to trade with each other.
So, Peter, do you think the old days of aid deals being done with developing countries with onerous conditions could now be over with this new world order?
I think the IMF has learnt a very important lesson here that even in some of the earlier packages in this crisis, such as Iceland, that countries will push back. And at the end of the day, they know that the aid needs to be provided. For instance, in the case of Ukraine, they will keep pushing and they will get more lax conditions. And at the end of the day, it's about providing this cushion to investors and to markets. And I think, as you said in the introduction, there were some bad examples in previous times of sort of hastily put together packages that didn't really best suit many of the economies that they were being given to. And at the end of the day, this sort of reform is better placed with people like the World Bank and the OECD, agencies such as that, not part of an emergency IMF package. So I think the IMF has very much learned its lesson around this, and indeed going forwards, I think we're going to see more of the same with the talk of this insurance scheme for countries, balance of payments insurance, which is similar to the FCL, Flexible Credit Lending Facility, that 3 countries have taken up during this crisis. So I think that's very much the way forward for them. But the problem at the end of the day for many of these packages for the IMF is that you're always looking at the last crisis. You can only really talk about previous troubles that countries have had, and things have changed. For instance, this time around we've had not only balance of payments crises but financial crises, unemployment crisis, which perhaps is still developing. It's obviously an open question. But the IMF needs to be as flexible as possible to deal with different problems in the future.
And in a sense, the financial problems that the world has seen has created quite a fertile ground to enable this change that is required by the IMF.
No, definitely. I think the important thing there is that they have seized the moment. There has been some sort of innovative policy making from within the IMF. Obviously, they have Oliver Blanchard, who is new chief economist relatively recently, and has been pushing forward some changes on the research side as well, which are pretty interesting that they're looking at more sort of vulnerability measures and that sort of thing. But I think overall they're going to have to be pushing for emerging markets themselves to be looking very closely at their own vulnerabilities at the end of the day, their neighbours' vulnerabilities in regional groupings as well. I think that's a pretty important thing that's going to have to happen in the future as well, because at the end of the day, it's always difficult for these international institutions and for analysts such as myself to stick your head above the parapet. Making a call on a country is going to have problems, for instance. So I mean, there's many people that can look at the issues. We have the new financial service board as well. So I think these new bodies and having as many people discussing the issues is very important.
And where would you say, Jan, that this leaves the famed Millennium Goals set back in the turn of the millennium? We're more than halfway there now. This issue, this idea of eradicating hunger and better education around the world, reducing child mortality and that sort of thing. Do you think this kind of change in world order could assist the likelihood of those goals being achieved?
Well, until the global economy gets back on track, these goals will be a little bit more distant. I think the key thing is to get the global economy growing again, both in the West and amongst emerging markets, because it is through growth that we can deliver on these higher goals, or more important goals ultimately. I think one of the key tests, though, of this issue of legitimacy isn't so much the voting share thing. It's whether the emerging markets, China, India, Brazil, and are giving the IMF the benefit of the doubt now, while they have some influence and the attention of the IMF, whether they will actually act in their interests ultimately, policy-wise. And that's terribly important. And the IMF has put the key issue is when emerging markets can begin to trust the IMF and the World Bank to act in their interests in times of financial crisis or economic recession, is when they can start lowering their own foreign exchange reserve, which they've built up as a kind of financial self-insurance after the Asia crisis, when arguably the IMF was a lot more stringent in terms of adjustment, and a lot harder in terms of policy. Whether the likes of China, India, Brazil, and other developing nations can honestly feel ownership of IMF policy and implement policy when crisis strikes, then there wouldn't be such a great need to build up very large stocks of foreign exchange as a kind of self-insurance. And by lowering those stocks, if that confidence, if that legitimacy is achieved with a bigger, more development-orientated IMF World Bank, then we will see the reduction in so-called global imbalances that everybody wants, including the United States. So there's a real key test of legitimacy here, whether developing countries, including the big leaders, China, India, Brazil, when they can feel as though they can take ownership of IMF policy and feel secure that the IMF and World Bank will act in their interests, best interests.
Okay, what about other emerging markets like Venezuela? Not a big player maybe, but suggesting that there should be an alternative to the IMF. What do you make of that, Peter?
I think, as I said before, it's up to individual countries if they want to make individual groupings to look at these issues. Then that's up to them. But I think you very much have to have, in a more globalised market, proper global players like the World Bank and the IMF that can be a lender of last resort. And that's always the question, is if you have, for instance, national governments can only provide so much help to national companies, for instance, then you work your way up and up. I think you do need definitely a global player that can act as this lender of last resort. But I think the reserve question is actually very interesting because the reserves were built up after the Asia crisis because of this mistrust. But markets and investors have got very used to them being in place now. We look at matrices of various ratios to reserves of things like exports and short-term foreign debt, this sort of thing. It would require a very big mindset change to suddenly do away with that. And in many ways, it's a bit like, for instance, the question in the UK of do we scrap our nuclear deterrent? things can change. You can't predict what's going to happen to the IMF over the longer term, to other institutions who might take care of those reserves. And I think potentially giving up reserves can be quite dangerous for some countries. And I think for the time being, at least, keeping them in place is important to keep markets on side through the recovery phase of this crisis.
Jan, you were talking a little earlier about the most important thing, of course, being, first of all, to get the economy back on track. Today, we hear about Australia raising its interest rates. What do you make of that? Is that a good sign?
Well, I think Australia and perhaps Norway were always going to be the first candidates for the so-called exit strategy. A rise in interest rates would be a reflection of a movement in that direction, certainly on the monetary side. I think Australia is a special case, though. It's got an unusual leg up because of its huge exports to China in the field of commodities. And so it was always a candidate to be first to make the move that signaled some kind of exit. Slow or unlimited though it is, it was, the next may be Norway. But by and large, I think the general consensus across the G20 is that the fiscal stimulus measures have to be kept in place. There is a risk of a double dip, if you like, recession, when stimulus packages either have their timeouts, many of them have timeout dates stamped on them, or when fiscal policies come to an end and they have to be renewed. So I think I think we shouldn't make a mistake. The only reason why we've got something called the recovery is precisely down to unprecedented and a broad breadth of state policies, whether it's fiscal, monetary or direct bank support. And quite frankly, the private patient is not yet able to get back on its feet. But the focus, I think, is quite right looking at developing countries and emerging markets, because I think it's precisely in the cultivation of this so-called emerging market consumer. There lies the alternative for rebalancing the global economy, an alternative growth driver to over-reliance on a pretty stretched and still struggling US consumer. I mean, that is where we will see genuine recovery and a genuine global rebalancing coming from. It's the emerging market consumer in their billions, if not billions, that is the great promise and potential for all of us, I think, including those of us in the developed world.
Okay, Peter, I just wanted to end with you, because you're in Istanbul right now, and I understand you're meeting pretty well every finance minister that there is there. What's the message you're getting from them?
Not quite meeting all 180-something of them, but quite a few. As I said at the start, I think it's very much about emerging markets doing what they need to do themselves, being very proactive. I think also the other future, which has been sort of overlooked slightly, is trade between emerging markets. Obviously, we're seeing China getting into Africa in a very big way. We're also seeing Russia providing loans to some CIS countries. So this sort of inter-EM story is one that I think is going to be something to look out for very much. There's a lot of contingent planning, I think, going on here. There's a lot of, as I said, there's some positive mood here, but there's a lot of contingent planning going on for a W shape, as well as increasing unemployment. The thing around unemployment is that it's going to keep increasing into next year in many countries, both in developed and emerging markets, and that's going to have some quite serious knock-on effects into the banking sectors in terms of non-performing loans, things like that. So the story very much isn't over yet. We're not out of this, but international institutions need to keep on that cushion to support these economies going forwards. And I think the assumption here is that will happen. But there are still questions to be cleared up around coordinated fiscal policy. There is an interesting reaction here to the Australian rate hike. Some people sort of said, they didn't coordinate on this. At the end of the day, it's an independent central bank. My argument would be, it's up to them.
Gentlemen, that's it. Great to get your perspectives. Thanks very much indeed in Istanbul, Peter Attard-Montalto and Jan Reldoff in London. Thanks very much. And thanks for watching Inside Story. As ever, please email your comments and thoughts insidestory@aljazeera.net. From me, Nick Clark, it's goodbye.